Welcome to a simple overview of dividend on investing. Fancy artwork and fancy words not included. I'm going to use an AI voice to narrate this video. It just makes my life easier with developing large presentations. Disclaimer. Before we get started, let's do the normal disclaimers. I am not a financial advisor. This video is for entertainment purposes only. Do your own research and consult with a financial advisor before taking any action in the stock market. Copying what some guy says on the internet is just crazy. I'm a believer in give a man a fish and you feed him for a day. Teach a man to fish and you feed him for a lifetime. I'm going to give you a fish to get you started. However, the market changes, new funds, stocks are offered, and some existing stocks funds get delisted. You need to have the skill set to be successful. Let's go over the basics. What is dividend investing? This is how I explain it to my teenage grandsons. Imagine you and your friends buy a cow. Each month, everyone is given their share of the milk. The cow is the asset/stock. The milk is the dividend. As long as you own the cow, you keep getting the milk. Dividend investing is a strategy where you buy stocks from companies that regularly pay dividends, which are portions of their profits given to shareholders. This way, you earn a steady income from your investments in addition to any gains from the stock's price increase. Paper loss versus actual loss. Imagine you and your friends bought that cow for $1,000. One day, the market price of cows drops to $800. Paper loss. This is like seeing the value of your cow drop to $800 on paper, but you haven't sold the cow. You still own it, and it can still produce milk. Dividends. Actual loss. This is when you decide to sell the cow for $800. You've now realized the loss and actually lost $200 from your initial investment. In financial terms, paper loss, a decrease in the value of an investment on paper. It's an unrealized loss because you haven't sold the asset. Actual loss, the loss you realize when you sell the asset for less than what you paid for it. It's an actual loss because the transaction is complete and you can't recover that money. Return on investment, ROI. Imagine you and your friends bought that cow for $1,000. After a year, the market price of cows drops to $800. You see a paper loss of $200 because the cow's value dropped. However, if the cow produces $50 in milk each month, that's $600 in a year. In financial terms, ROI helps you understand the overall profitability of your investment, taking into account both the value changes and the income it generates. Initial investment, $1,000 paper loss, $200, value dropped to $800, dividend income, milk, $600 total ROI, calculation, total income from milk, $600. Total value of cow after a year, $800. Combined value on $800 plus $600 equals $1,400 or a profit of $400. I bought Coney when I knew it was high at 27.84 a share. This month, Coney's price ranges from 24.13 to 19.72. At the time of making this video, it is currently at $20.29 a share or a loss of minus 7.55 a share. At 1324 shares, that is a loss of minus 9,996.20 on paper. However, it's paid a total of $17,351 in dividends since I've owned it. The price is trending lower. It has an up and down chart. However, even with the paper loss, I've made $7,354.80, and it will pay me another dividend in this month and the months to follow. This makes the ROI better as the months progress. Since it has a mixed up and down chart, some weeks it will be up and some weeks it will be down. So I don't plan on selling. As long as I hold it, I'll never experience the actual loss. The roller coaster of investing. Stay seated for the whole ride. Imagine you're at an amusement park and you've just gotten on a roller coaster called the market. Initial investment. You pay $50 for the ride, your entry point into the market. The ride, the car climbs up, plus 20. The market is going up, you're feeling great. Sudden drop, minus 30. The market dips, you feel scared. Loop-de-loop, plus 15. The market recovers a bit, you're dizzy but relieved. Another drop, minus 10. Another dip, you're tempted to jump off. Final climb, plus 35. The market rises again, you're glad you stayed on. End of the ride. If you stayed on, your investment is now worth $80. $50 plus $30 net gain. If you panicked and jumped off at the lowest point, you only have $30. During this time, we are still getting dividends. For the most part, unless the stock drastically declines, it really doesn't matter what the paper value is. Taking emotion out of investing. Black swan events and downward market movements. Market crashes or black swan events happen occasionally. Many panic and sell, locking in losses. Smart investors see this as a buying opportunity. Apple analogy. Let's say normally the price of an apple is $1. During a black swan event or a downward swing in the market, apples are 70 cents. You know the price will likely return to $1 eventually. The smart move is to buy more apples at a discounted rate. Key strategy: the bottom is unknown during a crash. Spread out your purchases in several chunks. This helps average out your buying price. Remember, stay calm, think long-term, and see market dips as potential opportunities. Pro tip: October is typically a tough month in the market with a downward trend. I often get things on sale in October. Diversification. Don't put all your eggs in one basket. Imagine you're a farmer selling eggs. Scenario 1. One chicken. You have one chicken laying eggs. If a chicken gets sick, you lose all income. Scenario 2. Multiple chickens. You have 10 different chickens. If one gets sick, you still have 9 producing eggs. Market parallel. One stock equals one chicken. Multiple stocks in different industries equal multiple chickens. Benefits: reduces risk of total loss. Some investments may perform well when others don't. Diversification. Back to my Coney example. On any given day, some of my dividend funds are green and some are red. If I look at my account as a whole, and not just Coney, overall, if I total all the stocks in my account, it seems to range between positive 4K to negative 12K, depending on where we are in its up and down cycle. However, I've been paid 45K in dividends since I've owned them, and I'm not experiencing any actual losses since I'm not selling. I'm just collecting the cash. Well, collecting and reinvesting it, I expect most of the funds will stay in a range, sometimes up or down. As long as I continue to hold the funds and not sell, I'll continue to get dividends and reduce my overall cost of ownership. Risks in dividend and investing. Dividend cuts. The company reduces or eliminates dividends. Regular stock risk. Like any stock, the value could go to zero. Reverse splits. When this happens, for example, a 2-to-1 reverse split, for every 2 shares you own, it turns into 1 share. This usually happens when a stock price gets very low and has a risk of being delisted. The dividend is supposed to be equal to what you received before. However, it seems that the dividend will continue to go down in the few cases I've seen. Lack of growth. Focus on dividends may limit company expansion. Tax implications. Dividends may be taxed as income. Determine your comfort level with risk before you invest. It's subjective, but here is a general guideline. High risk, range, 20% or more potential loss. Description: high-risk dividend stocks/funds, such as those in volatile sectors like technology or emerging markets, can experience significant price swings. Investors should be comfortable with large potential losses in exchange for high dividend yields and growth potential. Medium risk, range, 10% to 20% potential loss. Description: medium risk dividend stocks/funds, like diversified dividend ETFs or stocks in established but cyclical industries, have moderate volatility. Investors should expect reasonable returns with the possibility of moderate losses. Low risk, range, 5% to 10% potential loss. Description: low-risk dividend stocks, funds, such as those in stable sectors like utilities or consumer staples, typically exhibit lower volatility. Investors should be prepared for small fluctuations and modest potential losses while receiving steady dividends. Lowest risk, range, 0% to 5% potential loss. Description: lowest risk dividend-producing investments, like high-quality government or corporate bond funds with dividend payouts, offer minimal risk. Investors should expect very low potential losses and stable if modest returns. Let's talk about the last big market event, COVID. During COVID, prices dropped across the board. I didn't sell, so these price drops didn't affect me, and most investments recovered over time. Some of my holdings reduced their dividend, but none stopped. Some funds I didn't hold stopped their dividend entirely for a few months. I got more stocks for the same spending amount when the market was down. This experience shows the importance of staying invested and being patient during market downturns. We're going to invest in stocks, specifically ETFs and funds. When we receive dividends, we'll reinvest them to buy more shares. ETFs are funds that hold a collection of stocks. Advantages of ETFs: diversification. ETFs spread your investment across multiple stocks or bonds, reducing risk. Low costs. They typically have lower expense ratios than mutual funds, making them cost-effective. Liquidity. ETFs can be traded throughout the day on stock exchanges, offering flexibility and ease of trading. Disadvantages. ETFs may not grow as quickly as individual stocks. Some ETFs can be complex, involving derivatives or leverage, which increases risk and complexity. Let's set a simple goal: making an extra $100 a month. We'll choose a stock or ETF and figure out how many shares we need to reach that goal. We'll use 4 different stocks with different risk levels. Let's call them lowest, lower, medium, and higher risk. You'll see that the lower the risk, the lower the yield. If you have a ton of money and/or a ton of time, lower risk is appealing to most people. If you don't, then to reach the goal, you need to accept more risk. Notice that the lower the dividend yield, the higher the overall cost to meet the $100 a month goal. So how is risk determined? I feel it's subjective. Lowest, Johnson & Johnson, J&J, a well-established company that has been trading on the market for 60-plus years, is considered both a dividend aristocrat and king. Lower Devo, a well-established fund that has been trading since 2017, has an upward growth chart. Medium, JEPQ, only has been trading for a few years but also has an upward growth chart. Higher, AMZ, has been trading for around a year or less, has a very high dividend payment, and not a lot of historical data to review. Not sure how this will handle in a market crash event. Dividend Aristocrat, a company that has increased its dividend for at least 25 years in a row. Some investors also consider other factors when ranking dividend aristocrats, such as company size and liquidity. Dividend King, a company that has increased its dividend for at least 50 years in a row, which is an even more exclusive group than dividend aristocrats. As of October 2023, J&J had increased its dividend for 60 years in a row. What if you don't have a lot of money? Let's use the high-risk stock AMZ as an example. Time for some math. Save $25 a week or $100 a month. Each month, buy $100 worth of AMZ and reinvest any dividends you earn. We need roughly 155 shares to generate $100 a month in dividends from AMZ. By reinvesting dividends along with your $100 each month, you'll see your share count grow steadily. In just 15 months, you can get close to your goal. This is known as the snowball effect or the miracle of compounding dividends. An important point to note is that you only contributed $100 each month for 15 months, not the full $3,448 needed up front. Your total out-of-pocket cost was $1,500 plus time. This gets better. Continue to contribute your monthly $100 reinvesting the dividends and watch how this grows. Here are some caveats. This is a higher risk fund, about 10 months old at the time of this recording. The prices of the stock will vary over time. The dividends vary over time. 0.642 is the average of all of the dividends in the last 10 months. One should invest in multiple funds instead of all your eggs in one basket. Wait, you said this is higher risk. Correct. I consider this educated higher risk. Make a plan, paper trade the plan, execute the plan, and adjust as needed. Critical. If you do not paper trade, the chance of failure increases significantly. So where do we start? For paper trading, I use trackyourdividends.com. There's a free version and a paid version. I'm using the free one. For the funds themselves, I primarily use YieldMax ETFs, https://www.yieldmaxetfs.com. YieldMax trademark ETFs aim to generate monthly income through options-based strategies on various underlying securities. They seek to provide attractive yields from assets not typically associated with monthly income. Paper trading. Click on our ETFs on the YieldMax website and add them one by one to trackyourdividends.com. Since these are relatively new funds, I entered a buy price of $20 per share, the initial market price, and a quantity of 1, except for TSLY, which had a reverse split. For TSLY, I entered 1 share at $40. TSLY struggled to maintain its value while paying out dividends. We are looking for funds that hold their value. It's great if it goes up, but at the very least, we want them to stay in an acceptable range. I believe YieldMax has a solid strategy, but not all their funds perform equally well. So we're going to paper trade these to see which funds hold their value. Multiple steps. Use YieldMax funds that hold their value to increase my monthly revenue. With each purchase, include a percentage of medium-risk funds. Alternate between the top 4 and top 6. 9 dividend-yielding YieldMax funds. Once I reach my target amount, currently $15K, I plan to live on $5K and reinvest the rest. When the revenue hits $20K, I'll decrease my YieldMax spending by 5% and increase my spending on medium-risk funds by 5%. I will repeat this adjustment with each $5K increase in revenue. Since these funds are untested in a black swan event, I believe the medium-risk funds will hold up as they did during COVID-19 if the YieldMax funds do not recover. Note, if you're doing any of this in a brokerage account, make sure to plan for taxes. Important dates: declaration, date, the date on which a company announces the details of an upcoming dividend payment. Ex-dividend date, the cutoff date on which you must own the stock to be eligible for the declared dividend. Record date, the date on which the company checks its records to determine which shareholders are entitled to receive the dividend. Payment date, the date on which the dividend is paid out to shareholders. Why are these important? The value of the stock typically falls by roughly the amount of the dividend on the ex-dividend date. To be eligible to receive the dividend, you need to own the stock before the ex-dividend date. Some investors buy before the ex-dividend date to receive the dividend for that month. Others prefer to buy on the ex-dividend date because the stock typically drops in price by the amount of the dividend, allowing them to purchase the stock at a lower price, though they miss out on that month's dividend. So what? So to test if the stock has recovered since its last dividend, look at your paper trading price the day before the ex-dividend date. For my plan, anything that is over $20 on the day before the ex-dividend date is eligible in my plan to be purchased. For me, it means that the fund is maintaining its value. In your paper trade, sort it by profit, loss, then export it into Excel. Excel will be a handy tool. After deleting the losers, sort the remaining by dividend yield. This will give you your candidate list before we get into charting. You can use this method for any stock you're interested in. Charting. Let's look at a fund called Divo. So go to Yahoo Finance, then put Divo in the search field. You'll get something that looks like this. Once the chart comes up, click on the All, 5Y, 1Y, etc. You'll notice in this example over time, this fund trends up. Charts that go up good. This is worth our time to investigate further. Here is an example of something I wouldn't invest in, charts that go down bad. When people see a very high dividend in, this common sense rule sometimes goes out the window. The high dividend is certainly appealing, but if it continues to lose value over time, in my opinion, it's a bad bet. Up and down in a range. With dividend and investing, we're not going to get the growth that growth investors get. A fund that goes up and down in a range can also be acceptable. Of course, going up is best. However, we can still make money if the stock or fund stays in a range. If they retain their value on the paper trade account and the chart is up or mixed, develop your buy plan. I use the chart below. Play around with the percentages. I'd highly suggest that even if investing $100 a month, choose more than one. I typically use a 6-month average of their dividends, also if less than 6 months old. I'd prefer not to buy it since some funds seem to raise their dividends for the first few months, then drop off to a lower number. I usually highlight the less than 6-month funds so I don't confuse them with the funds I'm interested in. They can be winners in the future for me, just not today. Every month, I review the paper trade and make a new winner's chart in Excel like the one below. It takes about an hour a month, but like you, I work hard for my money. I want to have every edge for success I can get. This is what I own currently at the time of making the video. Do your research. Develop your plan. Paper trade. Don't throw everything in all at once. Buy a taste, then a bite, then a meal. Fill the fridge. Load up the freezer. This is just an overview to get you started. Develop a plan and rule set that works for you.